Should you invest in the companies where you shop every day? It's a question I get all the time. You go to Starbucks for your morning coffee. You scroll through Netflix every night. You just bought the newest iPhone from Apple. It seems so simple, right? You love the products, you see other people using them, so the company must be a great investment. This idea is popular because it feels intuitive and safe. You're already a customer, so you feel like you have an inside edge on how the business is doing. You see the long lines, you see the bags in everyone's hands, and you think, this company is making a ton of money, I should get a piece of that. This is the core appeal of what's often called familiarity bias. The upside to this approach is that it gets you started. For many people, the world of investing seems complex and intimidating. They hear terms like price-to-earnings ratios, diversification, and market capitalization, and their eyes glaze over. So, they do nothing. Investing in a company you already know and trust, like Target or Amazon, can feel like a comfortable first step into the stock market. It demystifies the process. You understand the business model because you participate in it. You know what they sell, who their customers are, and why people choose them over competitors. This hands-on knowledge can give you a real, tangible connection to your investment, making it feel less like a random ticker symbol on a screen. This familiarity can actually be a powerful research tool if you use it correctly. As a loyal customer, you're on the front lines. You're the first to notice if the quality of a product starts to decline. You can see if the stores are getting less crowded or if the customer service is suddenly terrible. You might notice that a competitor, like a new coffee shop, is suddenly stealing all the customers from your old favorite spot. These on-the-ground observations can sometimes be leading indicators that Wall Street analysts, who are sitting in an office staring at spreadsheets, might miss for months. Legendary investor Peter Lynch famously championed this idea with his buy what you know philosophy, arguing that amateur investors could use their local knowledge to find great companies before they became Wall Street darlings. However, it's crucial to understand that being a happy customer is just the starting point, not the entire investment thesis. Your personal experience is just one tiny piece of a much larger puzzle. You might love shopping at a particular clothing store, but that doesn't tell you anything about the company's debt load, its profit margins, its supply chain vulnerabilities, or the leadership team's long-term strategy. Seeing a busy store is a good sign, but it's not a substitute for doing real financial homework. The feeling of comfort can be deceptive, leading you to overlook serious red flags simply because you enjoy their product. We need to separate our emotions as a consumer from our logic as an investor. Now let's talk about the dark side. The biggest risk of only investing in companies you shop at is a complete lack of diversification. If your entire investment portfolio consists of Nike, Apple, and McDonald's, what happens when consumer spending suddenly drops? All of your stocks are likely to go down at the same time because they are all in the same sector: consumer discretionary goods. A well-built portfolio should be spread across many different industries, like technology, healthcare, energy, and finance. This way, if one part of the economy is struggling, another part might be thriving, which helps to smooth out your returns and protect your capital from a single sector downturn. Another major pitfall is confusing a great product with a great stock. Blockbuster Video had a fantastic product that everyone used and loved, but that didn't stop it from going bankrupt when it failed to adapt to the rise of streaming services like Netflix. Just because you and your friends love a company doesn't mean it's a good investment at its current price. A stock's price might already be incredibly high because everyone else already knows it's a great company. Buying at the peak of its popularity can lead to disappointing returns. The goal of investing is to buy a piece of a business for less than what it's truly worth, and that requires more than just customer loyalty. This emotional attachment can also make you hold on to a losing stock for far too long. Let's say you invested in a company because you loved their products, but now the business is clearly struggling. The stock price is falling, bad news is coming out every quarter, and the competition is eating their lunch. Because of your personal connection to the brand, you might tell yourself, oh, they'll turn it around. I still love shopping there. This is called confirmation bias. You ignore the negative evidence and only seek out information that confirms your original belief. This emotional decision-making can be devastating for your portfolio, preventing you from cutting your losses and moving your money to a better opportunity. Finally, your personal bubble is not the entire market. You might live in an area where everyone drives a Tesla, leading you to believe the company is completely dominating the auto industry. But that's just your small corner of the world. In other countries, or even other parts of your own country, different brands might be far more popular. Relying only on your own experience gives you a narrow and potentially biased view of the global marketplace. A company that is popular in your city could be a niche player on the world stage. To be a smart investor, you have to look beyond your own shopping habits and understand the bigger picture of global trends and competition. So, is it ever a good idea? Yes, but only if you follow a simple, logical strategy. Don't just buy a stock because you like the product. Instead, use your customer experience as the starting point for a deeper investigation. Think of it as a 3-step process. Step 1. Identify. Notice the companies you and others frequently use and pay for. Keep a running list. This is your potential ideas list, not your buy now list. This is the fun part where you get to be a detective in your own life. Ask yourself, why do I choose this brand over others? What makes them special? Is it their price, their quality, their customer service? Step 2 is the most important. Investigate. Now you have to take off your consumer hat and put on your investor hat. You need to do some basic research. You don't need to be a Wall Street analyst, but you do need to look at the fundamentals. Ask simple questions. Is the company profitable? Is its revenue growing year after year? Does it have a lot of debt? You can find this information for free in a company's annual report or on financial websites like Yahoo Finance. Look at what the experts and financial news are saying about the company's future prospects and its competition. This step separates a guess from an educated investment decision. Step 3 is to diversify. Never, ever put all your money into one company, no matter how much you love it. Even the best companies can face unexpected trouble. A smart strategy is to not invest in individual stocks at all, especially when you're starting out. Instead, consider buying a low-cost index fund or ETF, like one that tracks the S&P 500. This automatically invests your money in 500 of the largest U.S. companies, including many of the brands you know and love, like Apple, Amazon, and Microsoft. This gives you instant diversification without having to research and pick hundreds of individual stocks yourself. It's the simplest and most effective way for most people to build long-term wealth. If you are still determined to buy individual stocks of brands you love, make it a small part of your overall portfolio. A common rule of thumb is to keep individual stocks to no more than 5 to 10% of your total investments. The vast majority of your money should be in diversified, low-cost index funds. This approach gives you the best of both worlds. You get the stability and broad market growth from index funds, while also getting the satisfaction of owning a small piece of your favorite companies. This lets you have a little fun without betting your entire financial future on the success of your favorite coffee shop or smartphone maker. So let's answer the big question directly. Is buying a stock just because you shop there a good idea? No. It is a terrible idea. It's like marrying someone just because you had one good date. Your experience as a customer is a starting point, not the finish line. It's a clue that a company might be worth looking into, but it is not a substitute for actual financial analysis. Great products do not always equal great stocks, and popular brands can become terrible investments if their financial health is poor or if their stock is wildly overpriced. Your feelings about a brand are not a sound investment strategy on their own. Think about some real-world examples. Many people invested in Apple early on because they loved the iPod and then the iPhone. They saw a revolutionary product and correctly guessed the company had a bright future. That worked out incredibly well. On the other hand, many people loved shopping at stores like JCPenney or Sears. They had decades of customer loyalty. But that loyalty didn't save investors from massive losses, as those companies failed to adapt to e-commerce and changing consumer tastes. Your personal affection for a brand will not protect your money if the business itself is failing. This is why you must look beyond the storefront and into the company's financial books. Ultimately, a rich life is about living intentionally, and that includes how you invest. Don't let lazy thinking or emotional bias dictate your financial future. Use the simple strategy. Identify companies you know, investigate their financial health, and always diversify your investments, preferably with low-cost index funds. This disciplined approach will serve you far better in the long run than simply buying stocks based on a whim or a good shopping experience. Investing isn't about finding the one magic stock. It's about creating a system that builds wealth automatically over time. Your goal is to build a robust financial machine, not to collect your favorite brands. Before you make any investment decisions, you must speak with a qualified financial advisor. This article is for informational and educational purposes only. It is not financial advice, and I am not your financial advisor. Investing involves risk, including the possible loss of principal. Take control of your money, get educated, and build a plan that is right for your specific financial situation and goals. Your rich life is waiting. Want more no-nonsense advice on money and living a rich life? Subscribe to my newsletter.